Hey everyone, welcome back to Chart This with Gary Wagner. I'm Jeremy Szafron. Don't forget to hit that subscribe button to stay ahead of the trades. Now today's segment is all about breaking down the latest movements in gold, of course, through the lens of technical analysis. Now we've seen gold prices react well to the upcoming FOMC meeting. Spot currently trading over the $2,400 mark per ounce. Well, silver also slightly green today. Now our guest Gary Wagner says we might be at the beginning of a significant third wave in gold's bull run. Now he's accurately called these patterns before and believes that the breakout patterns he identified previously are continuing to drive this market. Let's welcome back our buddy Gary Wagner. Hey man, good to see you.
Thanks for having me. It's great to be here. And it's a perfect day to do that, coming up on the next FOMC meeting. And although we are almost confident that he will not implement a rate cut, meaning the Federal Reserve, not just Chairman Powell, but we're looking for veiled references that could signal a rate cut in September. According to the CME's FedWatch tool, there is a 100% certainty that at the conclusion of the September meeting, there will be some sort of rate cut, with the vast majority of the highest probability leaning towards a 0.25% rate cut. So we're going to want to listen to what the chairman says during the press conference and look for subtle word changes in the statement they release a half hour prior to him speaking.
Yeah, so many things to break this down. Okay, we're going to get into the FOMC meeting in a second, but let's stick on the gold front here, because Gary, in our last segment, you mentioned that, we might be at the beginning of a third wave on the bull count for gold. Can you explain what we're seeing in the charts and what led you to this conclusion? I mean, good one. Nice day to trade.
Yeah, certainly. Thank you very much. Basically, for those that are unfamiliar with Elliott Wave, he recognized that there was a consistent pattern within how a market trades based on the psychological makeup of the traders. And typically, if a market is moving to higher ground, and we'll call that a bull count or a motive phase, you typically will get the market move from $1 to $2 maybe, and then retrace. That corrective would be a wave 2. There's a total of 5 waves, 3 of them moving in the primary trend direction. So that's waves 1, 3, and 5. And then 2 in the opposing direction or counter trend. So the chart that we have up is a gold chart. And we're looking at, was a full count up to 5. And that 5, of course, you can see finished here. And then we went into a correction. The correction that unfolded was the descending top flat bottom that we've talked about. We've identified this pattern twice now. We also talked about how once gold broke above this upper level resistance line right here that's drawn from a series of lower highs, it's called a thrust. And I explained it last week as if you think of winding up a spring, every time it bounces from the high to the low, that spring tightens. And so when it does break above this, it releases energy and you get a sizable move fairly quickly. And that's what we witnessed. And so this is what I'm labeling as our wave 1. Our wave 2 saw gold correct from this high here at about, this is December gold now, 25.29 down to these lows at about 2,400. That was actually almost a 78% retracement, exceedingly deep correction. It's a strong correction, but acceptable. What cannot happen is for this low to go below this point or the starting point of the wave 1. And I now believe that we are in a wave 3. Typically, when we do basic models for a wave 3, wave 1 is what is called a benchmark wave. So once we have that in place and the wave 2 is completed, then we can start plotting where a third wave could go to. And it's also how I came up with the forecast for the end of the year and Q1 last time, is I measured the distance from 2353 up to 2527 and began a fib extension from 2403. So these green lines represent if the third wave is equal to the first wave, it would take gold to 2566, a 1.236% extension to about 2600. And if it's what's called an extended third wave, it could go as high as a 1.618% extension, and that's getting you, just close to 2675. Now, here's the key. That being said, even though we believe that gold could shoot up substantially higher, there is a fractal quality to Elliott Wave. So within a impulse wave 3, you can then subdivide it into a smaller count, typically 5. You can get a 3 count, but so this wave 3 can be looked at as a 1, a 2, a 3, a 4, and a 5. So it's going to stair step up. And the key to what we're looking at is there's a couple of golden rules in Elliott Wave, and one of them is wave 3 cannot be the shortest of any of the impulse waves, which is why when we do our upside prediction, we look at a minimum of a 1-to-1 relationship between this wave and the current wave 3. But it's exciting times that we have this kind of potential, and it allows us to be effective traders because we can look at the fundamentals at play. In other words, my belief is that the tone of the conclusion of the FOMC meeting will be interpreted as dovish. It will be interpreted as accommodative, and that they are ready to initiate interest rate normalization. They do that by cutting rates the first time. But as we talked about on the last show, it's so much more than that because it's not a single rate cut. It's a series of rate cuts between now and the end of 2026 to normalize interest rates. And right now they're looking at what they call interest rate normalization as anywhere between 2.75% and 3.25%, roughly at around 3%. Used to be 2%, but they'll feel as though they've accomplished their job, A, if they get inflation to their 2% target, and B, if they bring rates down to really juice the economy up, to create the kind of momentum you need that you get when businesses have a lower cost to borrow money.
Yeah, absolutely. Well said. I mean, Gary, going back to gold here, you mentioned these waves. We might be in the middle of this third wave. I remember you talking a little bit about triangles and the fact that they've broken out. I suppose that's what we're looking at. I mean, talk to me about the timeline here with that forecast. I mean, is that what's happening now?
Well, the triangle that I was talking about is typically a way that you have a correction. And so this is a triangle here, although it's a flat bottom and a descending top. What it means is that on a typical correction, we call it a zigzag. So market moves to the all-time record high, and then it corrects pretty much a straight line down, finds support, and then moves up, typically 50 to 75% of the move down, and then has one final move down. Whereas in a triangle correction, it typically goes back and forth between the triangle and the resistance and support line. And because the triangle narrows as it goes closer to the apex, that's where it supposedly, as theory has it, will build up energy. And that's why these breakouts, in other words, the point in time in which gold broke above the upper level resistance line, was so very important. And that's what we talked about. It was a very solid move up. We, in fact, put a couple of trades on, one last week. We put one on this week, and that was actually this morning, if I can try to get to it to give you an idea of what we were looking at. Yeah, there we go. Just give me a second here. And so we're looking at a very, very short-term chart. We entered the trade this morning, and we entered December gold at 24.29. That was on this candle here. As I said, I believe these are 15-minute candles. And initially, we put our stop a protective stop, because if we're wrong, we want to be able to limit our risk to an acceptable parameter at 2018. But as the market moved in our direction, we then raised it. So we're now sitting long at 24.29, and we have a stop at 24.34. So I can't say that we've locked in profits, because you can get gap downs, things can happen, but we've effectively not only limited the risk, but we have a very decent probability that we have locked in some profits on this trade. Now, on this trade, our upside target is 24.60 to 24.90. And so the question might be, well, why would you have a target at 24.90 if you think it's going $100 above that? And then to answer that question, that goes back to, as I said, the fact that, let me go back to this one. It's the fact that it's not going to move straight up. In other words, it's going to go up, correct, go up, correct, go up, and conclude the third wave. And so that's why on this particular trade, we're looking to get a piece of this fractal nature, this subdivision of the third wave. You can always divide these waves into more minute, smaller waves inside of waves. And it is like life itself, the patterns of growth or anything else. And it has a lot to do with using the Fibonacci sequence. The way you get those spirals, those are components in nature that define the patterns that we all witness in life, whether it's how a tree grows or other things. Yeah.
Yeah, no, it's fascinating. I mean, let's unpack this a little bit. We were talking a little bit before, Gary, and you mentioned using models to guide a trade. What specific trading strategy would you recommend for investors looking to capitalize on the current market conditions now?
I am a market technician, but I believe that fundamentals obviously drive the market. A market doesn't move to a certain point because the technical theories and studies you're using suggest that. They suggest that price point because it's a logical move based on the fundamentals. So the first thing to create a trading model is to look at the fundamental environment and decide if, take for example, the last inflation report. We were under the assumption that the inflation report would show that inflation has cooled slightly. And lower inflation makes it more, opens the door, let's say, for the Federal Reserve to actually beginning to cut rates, because they need to see certain criteria met, and they want to get inflation to their 2% target. One of the interesting things that Chairman Powell said recently, and this was at the Economic Club of Washington, and they asked him are you going to cut rates in September? And his response was typical Fed speak. He says, well, I'm not going to address that, but I will tell you that we're not going to wait till inflation gets to 2% before we cut rates. That's what I mean by Fed speak. He didn't say, yes, we're going to cut rates in September, but he also opened the door for a rate cut because inflation isn't at the 2% target, but they have the confidence that their moves that they have done, the restrictive monetary policy of raising rates 11 times and then pausing about a year ago, has got a lag in that it takes time to work itself through the economy. So by saying that they're not going to wait till inflation hits that 2% target was a veiled way of saying that we're ready to cut rates. And so it's reading between the lines. So if you have the belief that a report is going to yield a certain outcome, and you also have knowledge that typically that is bullish or bearish on a market. In other words, when interest rates begin to get cut, it's going to provide strong bullish tailwinds for both gold and equities. In terms of equities, the less amount there is to the cost of borrowing capital for a business to grow, the more they're likely to take on development projects and to move out into the future and spend the money now in order to capture it later on. In the case of gold right now, gold doesn't yield interest. So when interest rates were down at 0.25% or 0.5%, gold was a pretty attractive asset class because you're taking risks, but you can make a decent return. But once interest rates went up to 5%, now the investors are looking at, I have a guaranteed fixed return of 5% with no risk, whether it's a CD in a bank or whether it's a bond, and take very little or no risk, or I can have a substantial or reasonable amount of risk and not have that same guaranteed return. I'm going to not see gold as an attractive of an asset class as it is when interest rates move down. And so that's why it's bullish for both gold and U.S. equities. That is rate cuts is what I'm referring to. So as long as you believe that to be the case, that's how I would create a model. Always go ahead and back test it. Always work with it to make sure that it has decent results when you back test it, and then realize that just because it performed on paper historically doesn't guarantee it's going to do the same thing in the future. Nothing does. And so it's a matter of feeling comfortable with the techniques that you develop. You can work with market managers, whether it's a fund or other institutional traders that will do that on your behalf, or develop a model on your own.
Mm-hmm. Yeah, no, that's it's well said. It's something to think about for sure. I want to go back there for a second because, Gary, you brought up the CME's FedWatch tool. As you said, it indicates 100% probability of a rate cut in September. We know that we're going into this FOMC a little bit more hawkish, understanding what's exactly dovish, understanding what's taking place in the economy. How should traders position themselves in the gold market in anticipation of this? And more specifically, give me your outlook for the end of the year as well.
Well, we've been talking about my outlook for the end of the year. I just gave you my short-term outlook. The way you want to look at it is this way. Chairman Powell during the press conference is not going to say we're prepared to cut rates in September. We know that. So what we want to look for are veiled references. In other words, I believe he will set the seed of thought that that's what they're planning. And what do I mean by setting a seed? In other words, if he says something like, we have now gained the kind of confidence that we believe that inflation is on a strong and tangible track to 2%, and that we're comfortable acting at some time in the future to begin to normalize rates. So he's not going to say we're cutting rates, but you look for the types of statements that set that idea, set that seed in the minds of the investment public. And that's what we want to look for. What we did is we positioned ourselves by going long this morning. And we do offer that to any of our subscribers, our premium subscribers, where we do not only do our daily detailed analysis, but we issue trade alerts. We send them out on SMS, text message, as well as email, and then they can go ahead and place the trade for themselves. But we're giving them explicit parameters: buy at the market, put your stop here. So you can go to that level if you want a guided account, and nothing guarantees performance, nothing in the past and nothing you say. So always be exceedingly cautious with whomever you entrust with your hard-earned dollars. So I want to say that there is a lot of risk in this, but there's a lot of potential reward. So in the right hands, you have the opportunity to profit well. And even in the right hands, what you want to do is when you make incorrect calls, because that's part of trading, that you limit the risk to an acceptable level. And so get an idea of the fundamentals that you believe will occur. In other words, do you think that they'll announce a rate cut? Probably not. What are some of the word tracks that they might say? I have a feeling in the statement the tract has been, we need to have greater confidence. That's their tagline. So they'll have a play on words with that greater confidence that says we're fairly confident, or we're almost confident, or they'll use that phrase and switch a word out to show that they are closer to cutting rates than they were at the last FOMC meeting. So you look for subtleties within the Fed speak, as I call it, and Chairman Powell is an expert. He is fluent in Fed speak. He speaks in veiled languages. He keeps real feelings close to his chest. And at the same time, he tries to be transparent. That's a hell of a job to try to accomplish. Sometimes he does it better than others. Sometimes he doesn't do it that well. But the key is that it's not what he's saying, it's what he says actually means. And that's what you really want to get a sense for. And the analysts on CNBC and the financial news networks are really good at deciphering that language. And so you hear all of the analysts come on and say their sense to what they heard and what they believe that meant. And that's one of the reasons I got into technical analysis, because some will tell you that they believe that the words are implying 3 rate cuts, and someone might say it's only implying 1 rate cut, and they will both make genuinely sincere, logical cases for that hypothesis, and both of them won't be right. So you have to be careful in that analysts are silver-tongued devils, and that includes myself. We say what we believe, but just because we believe it doesn't mean it will come true. But it's what percentage of the time do we make correct calls is the way I look at it.
Yeah, well said. Okay, well, lots to get to. I mean, we're going to be keeping an eye, obviously, for the FOMC meeting. This nuanced talk, the Fed speak that Gary talks about. Our resident technical analyst, Gary Wagner, joining us from Hawaii. Thanks again for this, Gary. Nice trade this morning. Great time, though, too, because in 2 weeks, we're going to have you back and we can talk about these numbers and unpack them.
Sounds great. Look forward to it.
Thanks, Gary. I'm Jeremy Szafron. For all of us here at Kitco News, we'll have more on the FOMC meeting, of course, and what it means for the markets. Stay tuned.